Perfect. A lot of times other realtors don't realize how much interest rates bop around all over the place. And you can see here, there's constant movement. So a lot of times we'll hear a realtor say to us, oh my gosh, my client talked to so-and-so at, XYZ mortgage, and they said that their interest rate was too high, or they said their interest rate was lower than yours. Here is why, is because rates are always moving. So if a client talks to us on a Friday and then someone else next week, Tuesday, we could be looking at completely different scenarios. Most lenders across the board do have the same products, interest rates, all of that. There's just little intricacies to the day of the week it is. The biggest thing that goes into moving interest rates is what's going on in your economy, which we all know. We talk so much about the Fed with interest rates that oftentimes people forget. The Fed fund rate does not equal mortgage interest rates. And people say that constantly, but I don't know that it always resonates. What happens is the Fed speaks about things, they create a plan, they drive a lot of what's happening in our economy just with one of their meetings and what they're expected to do next. People from all over the world and other countries themselves invest into our 10-year treasury. Our 10-year treasury is supposed to be a really safe place to park money. As soon as they don't feel like it's a safe place to park money, which is what's been happening the last year, we have a huge discretion in interest rates. And that every single time something happens with the Fed, then we have these big emotional responses. So a large part of where we see these adjustments is inflation expectations. Inflation is the devil to interest rates. Interest rates are lower when inflation is under control because of what the Fed does. Same with employment, unemployment. A normal way to think of it would be, oh, interest rates are probably good when people are employed, when they can afford to buy things, etc. That is the exact opposite. Interest rates are worse when people are the most employed and can afford the most, because that's when inflation really kicks up. When the Fed started moving interest rates, they were doing it because they were thinking that it was going to help lower some of this inflation. The good news is we had a much stronger economy than really was expected, because we're seeing here, even though the Fed has hiked up interest rates, we're not seeing this low in inflation like the Fed wanted to see. We're not seeing unemployment numbers really sky high. We're not seeing any of that right now, which is really what they're pushing and where they're trying to get to. But their goal is to, how do we do it with a soft landing? They're not trying to push us into a recession. They want to push us there, but then soften it where we don't have total chaos in the economy. So we know that we've seen inflationary numbers slow. We know we've seen employment numbers vary a little bit. We know we've seen some of these things, but when will the Fed actually want to start cutting interest rates? We need to see a true economic slowdown. So you'll see here, this is a chart going back every Fed fund movement in history. And then you can see where we had recessionary periods. We're not trying to push ourselves in, but you'll see, okay, we saw up here, we entered into a recession, and then we saw the Fed go down here. This is how they try and taper our inflation. Then we saw 08, 09, they hiked the Fed fund rate, pushed us into a recession here. And now we've just been going up and up and up. And this is obviously just a little blip because of COVID. It's not the same as, 2008, 2009. And so now they're pushing us up, and they're waiting to try and get us to one of these great peaks without pushing us all the way into a recession. So what are they looking for? They're looking for an economic slowdown. They want to see inflation stop. They want to see, unfortunately, more people unemployed. They want to see decrease in retail spending. One thing that's really interesting as well is historically, when you go back to 08, 09, back into the early 2000s, people's spending patterns were completely different than they are today. Just generationally, the people that were spending money probably didn't have as much access to a credit card. My back in 2001, people's credit card limits weren't $30,000. That was not a thing then as it is now. So what's happening is it's taking us longer for us to have this hit actually hit the end consumer. Example, there's big talk about what's going to happen come October, which now we're in it, and people have to start paying their student loan payments again. I can tell you, when we calculate in student loan payments to someone's mortgage payment who had it deferred before, we're using 0.5% of what their student loan payment is every single month against their debt to income ratio. The percentage of loans that have over 48% debt to income ratio, meaning with their gross monthly income, over 48% of their money is being spent every single month, is wild. If you were on the other side of things and you could see people's finances, you would be blown away. And so note that as these student loans kick in, as all these things, we're slowly going to start seeing more of these recessionary like figures, which will hopefully then allow the Fed to lower their Fed fund rate, which then the markets respond positively to, because that's what they want to see and happen. And it puts more money into our 10-year treasury, which then helps interest rates go down. Of course, then that gives us the counter argument on the business side of things where, well, now we're in a recession, people are scared to buy houses, things like that. For our market specifically, which I'll show you later, we're not worried about what a recession will do to our values. We just really need interest rates to come down to offer affordability to clients again. The Fed continues to say they want things to stay higher for longer. This chart shows you, and why they want things to stay higher for longer is because they know inevitably that people aren't to their breaking point yet. They can continue to spend more. They can apparently afford the 8% interest rates because people are still buying houses. All of these things are still happening without fail. And so until we see a little bit of a dip, the Fed will not lower interest rates at this point. Now it's kind of predicted that there will be one more interest rate hike before we start to see the slowdown, the pause, or any lowering of where we expect Fed fund rates to go. Note, there's also a website you can literally go to, any person, any point in time, and Fed futures is what you just have to Google, and it'll give you a dot plot of where the people on the board expect the Fed fund rate to go over the next year, essentially. And you can see where people are putting their estimates at. This shows the futures of where we expect these to be. Each line represents, you'll see here, where those predictions were and when. So you probably think all lenders sound like a broken record right now, because we were all saying, oh my gosh, Q1 of 2023 interest rates are going to drop. Oh my gosh, Q3 of 2023 interest rates are going to drop. The amount of new construction closeouts we have in Q4, where I thought for sure interest rates would be between 4 and 5%, is crazy. And we are clearly just not there yet. And this is why. You'll see here, back in May of last year, this is where we're predicting interest rates to go. Now, this is the most recent prediction at the Fed meeting at the end of September. We expect the Fed fund rate to stay here until really July of next year. And now they're talking about tapering it then. But no one is really predicting that we're going to have this huge taper that we once thought we were going to have. What does that mean? It also means we don't expect to have this giant dip in interest rates. For those of us who have clients who are thinking they're going to have rates in the 3% again, that is nowhere in our future right now. For the next 3 years, if that is what you're waiting for, you are just not buying a house. You are continuing to rent. We are not going to see interest rates dip like that again. The Fed continues to say, and this is what our markets don't like, is that they think the inflation is persistent. They think that the consumers have more strength, as I mentioned. They think the labor market is really strong, and we need to see some more changes here. Politically, there's also some agenda between some of this as well, because you have to imagine as we go into next year, an election year, that the current administration, if they'd like to be voted back in, if people aren't happy about what things are costing them, where the Fed fund rate is at, there might be some political movement that also helps us keep interest rates a little bit lower. This is another comparison chart of where we expect interest rates to be headed over the next year and where we thought they were going to be headed by each prediction. This navy line up here is the most recent prediction of where things are at. Note, this is still showing 7%. Interest rates are higher than 7% right now. When they make these charts, they take an average of interest rates, and they're also assuming clients are paying points to get to those interest rates. There's huge spreads right now between a 7% rate and an 8% rate on what you would pay in points. It is becoming harder and harder again to get the liquidity to not pay points. And so most of these numbers always are going to include points. Also, make sure you know, if you are going to a website to get just kind of a pulse check on where interest rates are, because your client said, so-and-so quoted me 8%, but I saw online that they're quoting 7.5%. Typically, the main difference there is really just in how much they're spending to get that lower interest rate. So don't, or a credit profile or something like that. Also, if your client has lesser income and can qualify for some of the Home Possible programs, there's also huge improvements in interest rate from that as well. And you can see, back last March, here's where we expected interest rates to go. Now this is where the prediction is that they're going to be. We're still thinking interest rates are going to be in the mid to high fives in a year from now. Not this, all of a sudden we're going to get to 4%. And I think having the conversation with clients up front and show them, what does 6% do to their monthly payment? Is that worth them waiting while home prices go up? Probably not. So what will actually cause interest rates to go lower? What do we need to push us over that place? We need inflation to calm down. We need more unemployment, unfortunately. The Fed needs to see that our economy has slowed and that essentially we've been pushed into some form of a recession. The Fed will not stop hiking interest rates or pause interest rates until they see this happen. And then the other thing we really need to see happen is we need globally for people to have confidence in our economy again. We need them to see that people are making the right decisions, that when the Fed said something, that tracks with what the rest of the world thinks that we should be doing. A lot of the trading that we see happen in markets is largely emotional. After a Fed meeting, we'll always see rates in the bonds just trading one direction or the other really, really quickly. And then within a few days, they all kind of settle because the initial response is very, very emotional. And so the other piece is making sure your clients are working with a lender who's actually watching the market and understands these things to help guide them and help guide you through the process is a huge, huge piece. And really, it's the best way to save money in this market is working with a lender who's actually going to watch the market and make sure that you're locking on the right day. As we're seeing the market shift, clearly, especially if you're in Minnesota here, we are seeing just a different market in general. I've been hearing people in our company say for, a couple of months now, oh, everyone's doing a 2-1 buy down. Well, the 2-1 buy down became a big conversation in the spring, but in our market, no one was able to do it because everything was still in multiple offers. So right now, as we're seeing things starting to sit longer, this is a great opportunity. If you have any listings that are sitting and you'd like us to run one of these worksheets for you guys, we're more than happy to. And this is an example of one of Kathy Boris's listings recently that's been sitting under 300,000. So a really good price point for a first-time home buyer in Northeast. So a good area. And essentially the sellers are willing to contribute for this 2-1 buy down. The first year, the payment would be 5.5%. The second year, it's 6.5%. Third year, it's 7.5%. So really, the sellers are prepaying for the first year for the interest rate to be 2% lower, the next year 1% lower, and then back up to the market. But if you look at where we're timing the trajectory for where we see rates to go to, we don't really think that it's going to take 3 years for rates to come down. Hopefully we'd be refinancing them into a 30-year fixed comparable to the 5.5% where they started by the end of year 2. Other programs that are becoming popular with builders are even the 3-2-1 buy downs, where you can go to 4.5% your first year, then 5.5% your second year, and then 6.5% the third year. So all different options. Also, just in general, we're seeing more people be able to negotiate seller paid closing costs, which hasn't been something buyers were able to get in a while and scared a lot of people away. So if you have clients who started in the spring market and got kind of spooked by what was going on with rates and inventory, now is a really good time to revisit these people and say, hey, let's refresh your numbers, showing you a 2-1 buy down option, and then let's go find you a house that's been on the market for 2 weeks and negotiate a 2-1 buy down option. The other big thing you're going to start seeing in the market is condo changes. So last January, there was a bunch of changes to condos done that were all temporary changes because of the condo collapse in Florida. These were a response to that. In September, these all became permanent changes and things that you're going to start seeing pop up more and more on transactions. A lot of these buildings have gone through the work now and had the building inspections done, and they know that they need to work on these things. The biggest changes with this implementation, in addition to the changes we saw last year, are really that they're going to double check to see what the special assessment is for each individual unit. And then there's caps to that of what that person is allowed to take on and what the seller has to cover before selling the property. Additionally, they're going to be digging into each individual HOA owners who's late on their payments. Essentially, you can't have more than 15% of the business or the building be more than 60 days delinquent on their HOA dues. I don't think that's going to be a huge issue in our condo market. I would assume that most condo buildings, their tenants are paying, and that's all great. I think it's going to be a bigger issue when you have the smaller condo buildings where, you know, if there's 6 units, one of the people is close to that 15% if they're 60 days late. And then here is, and I know Taylor, I send these to you all the time. These are a great resource if you have any areas you'd like me to run them on, or just for social or whatever. But the conversation we are having with every single client is currently there is 112,000 people that are renting in Hennepin County who can afford to purchase. That's at rates at 8%. When that interest rate number goes down, you're going to have a big chunk of these renters who can now afford to purchase. But yet, we only have 2 homes for sale for every 1,000 people in Hennepin County. That is not enough inventory. And over here, you'll see there aren't enough homes being built either. I don't know the last time you drove around the Twin Cities and saw a big vacant area of land, unless you're 30 to 40 minutes outside of the cities. There isn't spots to just keep popping up homes. So because of that, we fully expect homes to continue to appreciate over the next 5 years. And as rates go down, I think that this number will even tick up significantly more, because you're going to have more people bidding on the same house, just like we've seen the last few spring markets. That is everything I have prepped for you guys on market information. Do you guys have any questions at all? Alexis, Taylor, anything you guys are specifically seeing that would be helpful from a real estate side of things? Haley, what about you? Did you learn something?
Yeah, definitely.
Good.
Good insight into your market.
Good. Well, as always, guys, if it's ever helpful for us to run a real estate report card for your zip code, or you have something, perfect, thanks, Alexis, or you have something where you're just, hey, I'm struggling with this client and they're really down payment cautious. Do you have a first-time home buyer program? Or we're really struggling with their monthly payment. What creative options can you come up with? We are officially in the market where there's plenty of room for creative financing options. We've got programs now where you can do as little as 1% down with no mortgage insurance. So an awesome resource for those people who just were really getting priced out of the market the last year or so. So as always, reach out to me anytime if there's anything I can help with. Otherwise, I hope everyone has a good rest of their day.
Thanks, Allison.
Bye.